In 17th century Holland, a single flower could buy a mansion on an Amsterdam canal. A tulip called the Semper Augustus was worth 6,700 guilders, the equivalent of 45 years of income for an ordinary family. The flower had no metallic gleam, no gemstone sparkle. It was just a plant that would wither and die. Yet in an unprecedented speculative frenzy, it became the star of the first financial bubble in human history. Welcome to Finance Traveler, where we explore the epic stories of money, power, and capital across time. The story begins in 1593. That year, the botanist Carolus Clusius brought a shipment of tulip bulbs from Constantinople to the University of Leiden in Holland. The exotic flower immediately captivated the Dutch. Its petals were dazzling, its shape elegant and refined, utterly unlike any flower native to Europe. It quickly became a luxury item sought after by nobles and wealthy merchants. Owning a tulip meant you had taste, status, and money. Holland at that time was in its golden age. The Dutch were known as the carriers of the sea, commanding the world's largest merchant fleet and controlling 40% of global trade. In 1602, the Dutch East India Company issued the world's first stock. In 1609, Amsterdam gave birth to the world's first stock exchange. The seeds of financial innovation had taken root. People had money and an appetite for investment, and they were looking for the next opportunity to double their wealth. The tulip became that opportunity. The tulip had a unique trait. It reproduced very slowly. Growing one from seed took 7 to 12 years, and even growing from a bulb took a full year. That meant when demand suddenly exploded, supply could not respond quickly. The imbalance drove prices upward. A rare variety called the Semper Augustus, with red and white flame-like streaks on its petals, sold for as much as 6,700 guilders, enough to buy a grand house on an Amsterdam canal. By 1634, the way tulips were traded underwent a revolutionary change. People no longer waited for the flowers to bloom. They began buying and selling bulbs that had not yet been dug out of the ground. This was the precursor of the futures contract. The Amsterdam Stock Exchange set up a dedicated trading floor for tulips, and other cities like Rotterdam and Leiden followed. Buyers did not need to pay the full price. They only needed to put down a small deposit to lock in a future batch of bulbs. That leverage mechanism lowered the barrier to entry, drawing in tavern keepers, fishermen, craftsmen, laundrywomen, even maids, who abandoned their regular jobs and poured into the tulip market. Let us go back to Holland in 1636 to see how futures trading actually worked. According to historical records, these futures contracts had a special nickname, wind trading, because what changed hands was only the promise of future bulbs, not the flowers themselves. Taverns became the main trading venues. Merchants gathered there to sign contracts, agreeing to deliver a certain number of tulip bulbs the following spring at a set price. Most of these contracts were not written down. There were no notaries, no deposit was even required. The only cost was 1 to 3 guilders for drinks. The courts offered virtually no legal protection for such transactions. But it was in this seemingly casual trading that the Dutch invented an even more sophisticated financial instrument, the option. There was a real historical background to this invention. In the autumn of 1636, tulip prices fell, and those holding futures contracts found themselves locked into purchase prices above the market rate. Among these speculators were powerful local politicians who did not want to take the loss. They used their political influence to change the rules of the game. On February 24, 1637, the Dutch Flower Merchants Association made a momentous announcement. All tulip futures contracts signed between November 30th, 1636 and the spring of 1637 would be converted into option contracts. That meant buyers were no longer obligated to purchase the bulbs at the agreed price. Instead, they had a choice. If the market price rose above the contract price, they could exercise the right and buy low. If the market price fell below the contract price, they could walk away, losing only a small fee. According to reports, buyers could cancel their contracts by paying just 3 to 10% of the agreed price. This rule change detonated the market. Why? Because options capped the downside risk. The worst a speculator could lose was the small fee or the drinks money. But if prices rose, they could capture the entire gain. It was like buying a lottery ticket, limited loss, unlimited upside. Under that mechanism, speculators stopped caring about what the bulbs were actually worth. They only cared about whether contract prices would go up or down. Prices soared. By the end of November 1636, contract prices had risen to about 10 times the price of the physical bulbs. A tulip variety called Childer traded at 1,615 guilders. At the same time, 4 oxen and a wagon cost 480 guilders. 1,000 pounds of cheese cost only 120 guilders. Ordinary bulbs, which had sold for tens of guilders, now fetched over 1,000 guilders. While a family's annual income was only 150 guilders, people mortgaged their houses, sold their land, even traded their daughters' dowries for tulip bulbs or futures contracts. The whole country, from aristocrats to commoners, was lost in the fantasy that tulips would rise forever. But every bubble bursts. On February 4th, 1637, at a tulip auction in Harlem, a batch of contracts suddenly found no buyers. Panic spread like the plague. People suddenly realized that the tulip contracts in their hands, those pieces of paper promising future bulbs, might never find another buyer. The selling frenzy began. In just a few days, tulip prices fell by an average of 90%. Rare varieties that had been worth a fortune collapsed overnight to the price of onions. Sellers who had contracted to deliver bulbs at high prices tried to force buyers to take delivery at 3 to 10% of the agreed price, but most buyers refused. Countless families were ruined. Courts were flooded with debt lawsuits. Desperate people turned to the government for help. But what could the government do? Before the crash, it had encouraged speculation by collecting stamp taxes on tulip transactions. Now that the bubble had burst, it was powerless. In April 1637, the Dutch Parliament ruled that all tulip futures contracts would be treated as gambling contracts. Buyers could cancel their obligations by paying just 3.5% of the contract price. That meant sellers absorbed almost all of the loss. Farmers and flower merchants who had sold bulbs at high prices found that their wealth had been nothing but paper. Haarlem's municipal warehouse filled up with unpaid tax tulips. Bulbs with a book value of 120,000 guilders fetched less than 3,000 guilders at auction. The collapse of the tulip bubble is often described as a disaster that destroyed the Dutch economy. But careful economic history research shows that the damage was far smaller than legend suggests. The real losers were the small speculators who had participated in wind trading with high leverage. Wealthy merchants and aristocrats were relatively unaffected because they traded in physical bulbs, and their rare varieties held their value better. Yet the significance of this bubble in financial history is far greater than its economic impact. Tulip mania was the first well-documented speculative frenzy in history. It revealed several core principles of financial markets. Scarcity narratives can create bubbles. Tulips were never worth that much, but the story of rare varieties drove prices away from reality. Leverage amplifies volatility. When people can speculate with only a small deposit, the market fills with easy money that pushes prices up. When panic strikes, that leveraged money flees all at once, accelerating the crash. Markets without regulation are more vulnerable to bubbles. Tulip futures trading happened almost entirely in taverns and private gatherings. There were no exchanges, no clearinghouses, no oversight. When contracts failed, the only thing to rely on was word of mouth and personal trust. Most important of all, a bubble forms when the price of an asset is no longer determined by its use value, but purely by the expectation that someone else will pay more. Tulips could decorate a garden and signal status, but their use value was a tiny fraction of their trading price. Prices detached from fundamentals cannot last. Every bubble shares the same feature. People stop caring what an asset is worth and start caring only about what the next buyer will pay. That is the greater fool theory. You do not have to be a fool yourself. You only have to believe that a greater fool will come along to take the asset off your hands. After the bubble burst, the Dutch government began to reflect. In 1643, the Amsterdam Stock Exchange adopted a regulatory framework requiring transparent trading, laying the foundation for modern capital market regulation. Dutch bond markets stabilized after 1648, and interest rates fell from 6% to 3%. But those measures came too late. Dutch economic supremacy had already been overtaken by England. Today, nearly 400 years have passed since Tulip Mania, but the same story has played out again and again. The South Sea bubble, the Mississippi bubble, the Wall Street crash of 1929, the dot-com bubble of 2000, the subprime mortgage crisis of 2008. Every time the script is the same, a new technology or asset appears. A scarcity narrative drives up prices. Leveraged money rushes in. Prices detach from fundamentals. Then a small trigger causes panic. The crash follows, leaving ruin behind. When the bubble bursts, it is always the last one in who pays the price. The Amsterdam archives still hold a page of municipal accounts from 1637. It records, received 3 Semper Augustus tulips in lieu of taxes, value 18,000 guilders. This item has been written off. That written-off tax payment is a footnote to an era and a silent warning to all who come after. Subscribe to Finance Traveler. We trace the flow of capital across centuries and help you navigate the future with clarity.